Particular uncertainties around the impact on consumption of recent and prospective developments in the mortgage market. Can you tell us more about the nature of these uncertainties and how they fed into your latest decision on the bank rate?
Well, I'd pick out a couple of things on that in terms of, one's a bit longer term and the other's more short term. Longer term, I mean, we have seen quite a switch. This last decade, we've seen quite a switch in the nature of the mortgage market in this country towards fixed rate mortgages. So, you know, I think about 80% of UK mortgages are now fixed rate and about 20% is floating rate. I think if you go back 10 years, it was certainly in the 60s, I think, 60, just a bit above 65. So it has shifted. And that actually was, I mean, that was a progressive shift over time. Now, actually, having said that, I think, you know, our staff certainly, when they do calculations, suggest that by the end of next year, I think something like 50% of mortgages will have repriced. So that's the variable rates, which of course will naturally reprice, and then those fixed rate mortgages that are coming up for new mortgages as new contracts. So, you know, that affects a bit the transmission, but it's, you know, the mortgage market is still an important part of the transmission system. Now, that of course will, as a result, I mean, you know, we have to be very sort of frank here, that will of course increase the mortgage burden for households, for those households that are either on variable rate or coming up to a fixed reset. The scale for the fixed reset, of course, depends on what the pre-existing rate is compared to the current rate. Now, coming to the short term, and this comes back to what we were talking about, the market movements over recent times. One of the consequences of the shift to fixed rate mortgages is that fixed rate mortgages price off the curve, the market curve. They're not priced directly off our official rate, whereas variable rate mortgages are much more closely tied to our official rate. They price off the market curve. What we saw during September, early October, again, because of the effects on the curve and the instability of the curve, was that pricing was very difficult for mortgage lenders to do. So mortgages were, you read all the articles, mortgages were being taken off the market because they were finding it hard to price and to offer a price for a period of time. That's the point. I mean, when you offer somebody a mortgage, you give them it for a period of time. And of course, the price was going up. We are now seeing, again, both of those elements settle down. There are more mortgage offers coming onto the market, and we're beginning to see now the price come down, because one of the points we make is that although we increased obviously our rate by 75 basis points, that was fully priced into the market in the curve. What we are seeing now, as we were talking about with this risk premium coming out, is that the new fixed mortgage rates are beginning to come down, which is what I would have expected to happen.
Thank you. Anybody else know? Okay. Lenders were quick to increase mortgage rates following the mini budget on the 23rd of September, but have been slower to reduce them in lines with falls in swap rates. Do you have messages for lenders about their approach?
Well, I mean, I have given the message on prices that this is what I expect. You know, I would expect to see happen. And quite when it happens, I think that is a decision for lenders, because they've got their own pricing arrangements. But I would have been surprised and frankly disappointed if we hadn't seen this happen, and we are now seeing this happen. So that's what I would say in terms of fixed rate loans.
How damaging was the mini budget for first-time buyers in both the short and medium term? Because we had the major lenders in a few weeks ago, and while they completely agree with you that more products are coming back onto the market, they told us the ones that are missing or not as coming back as quickly are the high loan-to-value ones that specifically you would anticipate the first-time buyers would be looking at.
Yes, and that's important, because the lenders will be more cautious about those mortgages because they're higher loan to value. Therefore, they've got a smaller slice of, if you like, sort of equity in them. So that's not unusual to see that delay. I would hope and expect that we will see that, that come away too. But obviously, to your point, I mean, if you were trying to get a mortgage during that period, first-time buyer or second-time buyer, you were going to find it much more difficult. I mean, it was a very difficult period, and we saw this obviously in a lot of press coverage of it, honestly, quite rightly.
Do you think lenders acted fairly in the way they withdrew loads of those products and offers. I have a particular constituency example which I've mentioned several times of a young woman who was hoping to buy on a shared ownership basis, only to have the offer withdrawn just after the mini budget, and then several days later to come back with an interest rate about 2% higher.
Well, I don't want to. I mean, I can't. Obviously, I hope you understand. I can't comment on any individual cases. That's not possible. What I would say is that it was very difficult for the lenders to price mortgages when the curve was so unstable. That's the problem. I mean,
and that instability was directly as a result of the mini budget.
We're in a very, very unstable period. Yeah.
Thank you. Many market commentators are predicting falls in house prices over the coming year. I think the Nationwide, gentleman from the Nationwide was looking at kind of between 8 and 15%, but out on his extreme end, he did consider 30. I appreciate that's kind of a very large number, but what does the Monetary Policy Committee expect to happen to house prices over the next year?
Well, we don't directly forecast house prices. However, two things I would add in comments on this. First of all, I mean, some of the sort of the parts of the story that we've talked about quite a lot already this afternoon. So obviously the real income shock, the prospect of recession, the fact that we've got wages that are obviously in real terms not increasing, all of those things will have an impact. The second thing I would say is that if we look at quite a lot of housing market indicators, I think they are all now showing a weakening, both the activity and the price numbers. I say weakening in particular the price numbers more in terms of a weakening of the rate of growth. I mean, there was a series published this morning which was almost flat. Have come off further, and I think that's the weakest for a year or more actually. And also I'd say the volume numbers, so the number of transactions have also weakened. So we are seeing that.
What impact will price falls have on consumption and inflation?
Well, I think that's quite hard to actually. It depends on the sort of the cause of them. And so you also just want to say it's not necessarily price falls. The other thing that you've got to look at is what I would say is is loan to income ratios, for instance, and debt servicing ratios. So, obviously one of the consequences of us tightening monetary policy is that debt servicing ratios are going up. And it is also quite possible that even if in real terms, house prices don't rise in nominal or real terms, you've then got to relate those to whatever happens to earnings. So I don't know if colleagues may want to come in on this, but on its own, I wouldn't look at house prices just on their own.
I mean, it's part of the, we don't, as Andrew said, have a separate forecast, but I would see it as part of the overall effect, for example, of tighter monetary policy, that has on consumption, rather than picking up the cause of house prices directly. The other thing I'd say is that as important in a typical cycle as those effects on consumption and what happens to housing investment, which is extremely volatile and extremely cyclical. So it is the case, and this is in the report, that we expect falls in alongside falls in housing transactions, we expect falls in housing investment. That's both spending on renovations and building of new houses.
It's also worth saying, and Catherine was discussing this, because coming from a US background, it's quite different. That the UK mortgage market is different. The housing contract is different in this country. You can't walk away from houses as you can in the US. So what we find, and this has fed a lot into the FPC's work on housing tools, is that consumers will prioritise mortgage servicing over other consumption. So often it's the weakness in other consumption that shows up.
So when you were asking the question about the implication for consumption, it's very important to distinguish between a borrower who has to refinance at a higher interest rate because their term of their mortgage has run off, and so they have to refinance. It's a higher interest rate. It means they have to pay more. That has an implication for consumption because they're going to prioritize paying the higher mortgage. That's different from a house price fall for somebody who doesn't have to refinance. They might look at, if we think of housing as a way of saving, if the price of it falls, it kind of looks like your savings isn't as big as you hoped it would be. And so you may consume less because you want to build up these different types of savings, the housing savings and the bank deposit saving. But you don't have to do that. Whereas the first one
we can only hope that we could return to a time when we regard housing as somewhere to live. So, yeah. As you suggested earlier, you gave the proportions. Only around 30% of households have a mortgage. Of those, only a fifth are on floating rate, and only a quarter are on fixed rate that will expire by the end of 2023. How much of the burden of fighting inflation is being borne by the minority of households?
Well, I think obviously one of the impacts of introducing the growth in the fixed rate mortgage system is that it does have differential impacts, therefore, across households, depending on when your mortgage resets, as Catherine was saying. Because unlike the US, obviously, our fixed rate periods are short, not like the US, we're there for the life. So obviously, I'm afraid there is a bit of sort of luck of the distribution that comes into that as to when your mortgage reprices versus the interest rate cycle.
The thing to say is that monetary policy works through lots of channels. It's not just the cash flow effect that Catherine was talking about is important, but there are lots of other ways in which monetary policy affects inflation. So I don't think we should imagine that it's only those people who have mortgages, or even amongst those, only those who have to reprice, who as you say, bear the brunt of fighting inflation.
For example, the buy-to-let market is another channel through which, again, agreeing totally with Ben, there's many different channels for monetary policy, but just focusing on this one associated with housing, the buy-to-let market, the question is, for those owners, landlords, when they reprice, what happens? Do they pass on the higher cash flow obligations to their renters? And so that expands the pool of citizens and others who have to pay for a higher cost of housing.
Interestingly, we've seen rather more of a shrinkage of the buy-to-let market in the last year or so than certainly I'd sort of expected. I think that may be down to sort of some of the tax system has become more complicated, and so some of the people are saying just don't want to. I don't want to be bothered with this anymore. But it's quite interesting. It's shrunk more than we expected.
Thank you, Chair.
Thank you so much, Siobhan. And just on this important question of mortgages, because it matters so much to our constituents, how much, as of today, versus a year ago, you've moved the base rate from 0.1 to 3%. So inevitably mortgage rates have increased. Yeah. How much of the increase that you see in the mortgage market today has come from that independent decision by the Bank of England to tighten monetary policy, and how much has been due to the disruptions of the gilt market that we saw in September and early October?
I think the September-October thing was obviously a fairly short-lived thing.
That's gone now.
Well, I think it's pretty much on the way to have been gone. Yes, so I think that was a thing that sort of ran from sort of, I don't know, let's call it at the beginning of September through to sometime middle of October, and then obviously it didn't disappear immediately, although some of it came off quite quickly. So that's a much more short-lived.
We can send all our grumpy constituents about their increased mortgage rates in your direction.
To us, yes. Well, of course, I'd love you to send us somewhere else, but I'm afraid. But of course, as is a deliberate thing in that sense. I'm afraid ours is the longer run effect, I think.
And of course, as Rishanara rightly says, except for the ones you had to fix during those few weeks.
Yes, indeed. And that's one of the problems, as I was saying, about the sort of luck of the timing thing. Of course, you can be very unlucky in that.
Compensation from the former Chancellor and Prime Minister.
Let's see you to the pursue.
Alison, do you want to come in now?
Sure.
Yeah.
I've just got some questions around the sort of around fiscal policy and the relationship that you've had with the Treasury and the government